Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show today, as household debt ticks higher, can the economy withstand a shrinking consumer? And plans to add more homes take on new urgency. We'll take a closer look. Plus, does Canada have a competition problem? The man in charge of it seems to think so. That's all ahead. First, though, for the week that was in business, it's time for the briefs. There were welcome signs this week that inflation in the U.S. is cooling, with prices in November increasing, but at the smallest rate in a year, putting core inflation at 6% from a year earlier. That takes some pressure off the U.S. central bank. Still, the Federal Reserve raised interest rates this week, up 0.5% to 4.5%. And while the Bank of Canada recently indicated a pause could lie ahead, there was no such relief south of the border, where rates are expected to rise above 5%.
The Fed is not going to hesitate to continue raising rates, and we still have more rate hikes to be realized even after this 50 basis point move.
And while our top banker says he will watch the data, Tiff Macklem also said this week he would rather go too far and raise rates higher than necessary than stop before inflation is tamed. Points for honesty and bravery.
If we raise rates too much, we could drive the economy into an unnecessarily painful recession and undershoot the inflation target. If we don't raise them enough, inflation will remain elevated. With inflation running well above target, this is the greater risk.
A grim reminder of our economic weakness came in the form of the household debt figures. StatsCan says that Canadians now owe $1.83 in debt for every dollar of income. That number climbed even as disposable incomes rose 0.8% in the 3 months ending in September. Credit market debt rose 1.2% at the same time.
Consumers are definitely turning more and more to credit cards, other forms of unsecured debt, and we're absolutely seeing that piling up right now.
The average price of a home in Canada declined again in November to just over $630,000, a 12% drop year over year. Data from the Canadian Real Estate Association also show that sales are still way down, 40% below year-ago levels. Regulators also confirmed stress tests will remain in place. That means new buyers have to show they can pay mortgages up to 2% above current levels or 5.25%, whichever is greater. Canada's healthcare crisis got even more political this week. While the provinces accused the Prime Minister of refusing to even meet to talk about a path forward, the leader of the NDP threatened to pull his support for the government if more action isn't taken. Jagmeet Singh didn't specify what the Fed should be doing other than spending more money and reaching an agreement with the premiers. Elon Musk lost his place as the world's richest man this week as a sagging share price of Tesla dragged down his net worth. The top spot is now held by Bernard Arnault, the man who heads luxury brands firm LVMH, which includes names like Louis Vuitton and Tiffany. Despite the dramatic decline in Tesla's stock price, Musk has been selling billions of his shares, including $3.5 billion this week alone. And those are your business briefs. Canadians were already deep in debt before interest rates started rising. Now many are also facing declining net worth as the value of their homes falls. So does that add up to a consumer that could tank the economy? Benjamin Tal is Deputy Chief Economist at CIBC. Benjamin, great to have you with us.
A pleasure. Thank you very much.
So we watch closely because the consumer powers this economy, and now we have, of course, even more indebtedness than before, and maybe a change in confidence out there. Are you worried that this will create a recession where it might not have to?
Yes, I think that will create a mild recession. This consumer is going to slow down. Consumer confidence is down, and although the labor market is strong, wages are rising. Clearly, the debt situation is a factor, and the wealth effect of falling house prices and the stock market clearly impacting the psyche of the consumer, not only the consumer, but also the Bank of Canada. I think that for the first time in a while, the housing market and the slowing in the housing market is entering the psyche of the Bank of Canada and maybe impacting future decisions regarding interest rates.
It was interesting to hear our central bank chief, Tiff Macklem, saying he'd rather go too far than not far enough. Obviously, taming inflation is important for the economy, Benjamin, but if you were advising, how does he measure how much the rates he's already put in place will work their way in? Has he done enough? What are they watching for?
Well, they're looking at the consumer first, and then they're looking at the housing market and how quickly the housing market is slowing down, then business investment, all kinds of categories to make sure that the effectiveness of monetary policy is there. The problem is that inflation is a lagging indicator. Inflation is telling you what happened in the past. Inflation peaked 6 months after the beginning of each recessions in the past. So they know that they might be overshooting, but remember, their focus is inflation and inflation expectations. Their nightmare is that you and I think that inflation tomorrow will be even higher. They would like to avoid that, to avoid the mistakes that were made in the 70s. And that's why they are willing to create a recession just to make sure that they are safe.
Because we've seen these modest drops in the month-to-month signs of inflation, we just got another one from the U.S., can we say it's working? Can we say there's some modest reason for optimism? Not that the numbers we're seeing are comfortable. They're still really high for inflation, but they are not as high as they were a couple months ago.
Well, that's more luck than brain, quite frankly, because most of the decline in inflation is coming from outside, the supply-driven inflation because of a supply chain and other things, nothing to do with the Bank of Canada or the Fed. So I see inflation rates going down from about 7% to 4% like that. By April, we will be at 4%. The trick will be to move from 4 to 2%, which is the domestic inflation, the wage segment of the market, the labor market. All those forces suggest that that will be more difficult, and that's why they would like to keep higher for longer, just to be sure.
So are you expecting a rate hike from this central bank in January, Benjamin?
No, our call is 4.25 and call it a day. But when are they going to cut? Usually the distance between the last hike and the first cut is very short. This time I think it will be relatively long, maybe early 2024, to make sure that inflation is dead. Don't start easing before you're sure that inflation is dead. And I think that's the motivation as far as they are concerned, and the Fed as far as they are concerned.
Benjamin, always good to have you with us. Appreciate it.
A pleasure. Thank you.
Benjamin Taub, Deputy Chief Economist at CIBC. Coming up, it is clear that millions of new homes will have to be built in Canada to improve affordability, but where and what kind? Stay with us.